You're sipping your morning coffee, checking your investment app, and boom, the numbers have dipped overnight. Not because of a recession, not because your favorite company tanked, but because thousands of miles away, missiles flew over deserts, oil fields caught fire, and suddenly the Middle East is all over the headlines again. This isn't just about politics, it's about your portfolio. Because when conflict ignites in regions rich in oil, resources, and trade routes, the ripple effect doesn't stop at the border. It hits Wall Street, your retirement fund, and even the price of gas at your corner station. In today's video, we're peeling back the curtain on how war in the Middle East, especially the latest tension between Israel and Iran, impacts everyday investors like you and me. And more importantly, what you can do about it. War and markets. Why investors should care. Wars don't just shake borders, they shake balance sheets. When missiles are launched in the Middle East, the ripple effect doesn't stay in the desert. It hits oil barrels, stock indexes, currencies, and yes, even your personal investment portfolio. The most recent flare-up between Israel and Iran is a textbook example of how fast this domino effect works. On June 13th, Israeli forces launched targeted airstrikes on Iranian nuclear facilities. Within hours, Iran retaliated with a barrage of missiles and drones, some striking Israeli soil. Within days, global financial markets started reacting. Brent crude spiked past $74 a barrel. Oil and gas stocks surged. Defense contractors rallied. Meanwhile, tech stocks, travel, and consumer sentiment sectors faced a dip. Why? Because global markets don't operate in isolation. They're ecosystems, connected by energy, shipping, commodities, and human psychology. And nowhere is that more obvious than when war touches the Middle East, a region that holds both political volatility and economic muscle. But it's not just about what happens in Tel Aviv or Tehran, it's about how markets perceive risk. Every flash of conflict introduces uncertainty, and uncertainty is the kryptonite of investor confidence. Even for someone with a diversified 401k or a simple ETF portfolio, volatility from these headlines can show up in returns. Gas prices might spike. Global trade routes may be rerouted or delayed. Inflation expectations can swing wildly. Central banks might reconsider interest rate paths. And all of that trickles down into everyday economic behavior. This is why investors, not just diplomats, care deeply when war breaks out. Because in the age of globalized finance, battlefields send aftershocks that shake more than just the ground. They shake the foundations of portfolios. The oil effect. Energy as the domino. If wars are earthquakes, then oil is the fault line. The Middle East doesn't just sit on geopolitical tension. It sits on a massive portion of the world's oil reserves. And in today's interconnected world, energy prices are the fastest way regional wars impact global economies. It's no surprise that one of the very first things to react to the Israel-Iran conflict wasn't soldiers or politicians. It was oil futures. When Israel struck Iranian nuclear and military targets, oil prices spiked almost instantly. Brent crude shot up, dragging global energy markets along with it. Why? Because about 30% of the world's seaborne oil passes through the Strait of Hormuz, a narrow waterway right on Iran's southern coast. If conflict threatens that corridor, even indirectly, the entire planet starts to feel the tremor. But it's not just about fuel. Oil is the invisible ingredient in almost everything. Shipping, manufacturing, agriculture, plastics, logistics. When its price jumps, the cost of business goes up everywhere. Your Amazon delivery? Pricier. Groceries? Transportation costs pass that to the shelves. Construction materials? All impacted. War-driven spikes in oil translate to inflation across the board. That's why investors and central banks alike monitor Middle East developments like hawks. Because when oil climbs, inflation expectations rise. And when inflation expectations rise, interest rate forecasts shift. One domino tips the rest, from crude barrels to central bank decisions to stock prices. Still, oil's reaction can be short-lived. Once markets sense a de-escalation or see supply adjustments from OPEC or the US, prices often cool down. But the key takeaway is this: energy is the transmission belt from war zones to stock tickers. Understand oil, and you understand one of the clearest signals of how war affects your financial life. Short-term shock, long-term memory. Zoom out with me for a moment. Over the last century, the world has seen more than 50 major geopolitical crises, from Vietnam and the Cuban Missile Crisis to the Gulf Wars and 9/11. Each shook the markets, briefly. A Harvard study found that in most cases, the S&P 500 dipped during the crisis period but rebounded within 6 months. Sometimes it even soared. Take the 1980 to 1988 Iran-Iraq War. Brutal, long, costly. But during that same window, the US stock market experienced one of its strongest bull runs. It wasn't the war that dictated the direction of the market. It was the business cycle, tech innovation, and Federal Reserve policy. This is key. Markets react quickly to uncertainty. But once the dust settles, fundamentals take the wheel again. Investor psychology, fear versus facts. Let's face it, the stock market isn't just numbers. It's emotions with decimal points. War headlines play into our deepest fears. Words like escalation, missile strikes, or nuclear threat flood our news feeds. Our first instinct? Protect what's ours. For investors, that usually means selling fast. But here's the problem. Fear is expensive. Emotional reactions to global conflict often result in buying high and selling low, the exact opposite of successful investing. The reality is, most geopolitical crises result in temporary volatility, not lasting damage to diversified portfolios. Yet many investors still fall into the same psychological trap. They mistake volatility for risk. Volatility is movement. Risk is loss. And history shows that while wars may bring short-term volatility, they rarely cause long-term destruction. Unless they fundamentally change the global economy, which is extremely rare. What tends to hurt investors most is uncertainty, not conflict itself. Before an attack, before a war declaration, that's when the market is most anxious. But once an event happens, markets begin to price it in. The unknown becomes the known, and investors regain their footing. To beat this trap, you need discipline. That might mean writing an investing policy statement, working with an advisor, or simply taking a break from financial news when it gets overwhelming. Remember, fear sells. News networks make money off your attention. But your portfolio isn't a breaking news ticker. It's a long-term machine designed to grow over decades, not days. So the next time a headline rattles your nerves, pause. Ask, is this a real threat to my financial plan, or just another storm to ride out? Because the best investors don't let fear do the talking. They let facts do the leading. What's different this time? So is this Middle East flare-up different? Let's assess. Israel and Iran are two major players, and this isn't a proxy conflict. It's direct strikes. That ups the stakes. Critical infrastructure is being hit. Nuclear sites, oil refineries, and energy grids. Markets are already strained by interest rate anxiety, inflation fears, and a cooling global economy. But there are buffers. Iran produces about 3% of the world's oil, most of which goes to China. Saudi Arabia and other OPEC+ nations can ramp up supply if needed. The US, again, is largely self-sufficient in energy. Even after Iran's missile barrage in early 2024, which briefly spiked oil prices, the market settled quickly. Global equities, as tracked by the MSCI World Index, are actually up nearly 30% since the October 2023 Hamas attack. That's not to say markets are ignoring the conflict, but they're digesting it through a familiar lens. How bad is this really for global trade and corporate earnings? Strategies for everyday investors. All right, as we've talked about what's happening and why it matters, now let's focus on what you can do as an everyday investor. Because while you may not control geopolitics, you can control how you respond. 1. Diversify like you mean it. This is the golden rule. Don't put all your money in one sector or region. Energy, healthcare, defense, utilities, these tend to weather storms better than growth-focused sectors during volatility. 2. Think long, not loud. You're not investing for next week, you're investing for the next decade. If your goals are years away, don't let temporary events derail permanent plans. 3. Don't time the market. You might guess right once, but guessing the bottom and the top? Highly unlikely. Dollar cost averaging, investing consistent amounts over time, beats timing almost every time. 4. Use conflict as a learning lens. How did your portfolio react to past wars or economic events? Use these moments to test your risk tolerance, rebalance if needed, and grow your financial confidence. 5. Watch oil, not panic. Oil prices are your early warning system. If they spike and stay high, inflation may follow. But short-lived spikes are common and often correct themselves quickly. 6. Keep emergency savings intact. A solid cash cushion lets you avoid selling investments during downturns. It's your personal buffer, your Strait of Hormuz, if you will. 7. Stay calm, stay curious, read, learn, zoom out. Fear thrives on ignorance, but knowledge? That's where power and profit lives. At the end of the day, the market rewards patience, perspective, and planning, not panic. Where we go from here. So, where does this all go? No one can predict the next headline, but we can identify the signals. Diplomats are already pushing for de-escalation. Iran has reportedly shown interest in restarting nuclear talks. Meanwhile, Israel is managing multiple fronts, Gaza, Lebanon, and Iran, but hasn't indicated a desire for full-scale war. That's why, despite the noise, global markets haven't collapsed. Why? Because they're not seeing a full-scale global conflict yet. They're watching us cautiously, but not panicking. As an investor, this is your cue to do the same. In the coming months, expect continued volatility. Oil may rise and fall. Inflation numbers might swing. Interest rate decisions could shift, and the news cycle will be intense. But through it all, remember this. Markets reward the investors who act on fundamentals, not fear. So take this moment to recheck your financial goals. Review your allocations. Make sure you're not overexposed to one sector or region. Strengthen your emergency fund. Reinvest dividends. Stay curious, but not reactionary. In fact, some of the best buying opportunities often come during global uncertainty. When others sell in fear, long-term investors can buy quality assets at a discount. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is not to trivialize war. The human cost is staggering. But if you're managing a portfolio, your job is not to react emotionally. It's to respond intelligently. Because whether peace arrives next month or conflict lingers, one truth remains. Your financial future depends far more on your habits than on the headlines. So zoom out, stay steady, and let your strategy lead the way. War may shake the world, but it doesn't have to shake your wallet. The most dangerous investment move isn't holding through a crisis. It's panicking in one. If you found this breakdown helpful, do me a favor. Hit that like button so more people can see it. Subscribe for more smart financial takes rooted in real-world events, not clickbait. And tap that bell icon so you never miss a chance to grow your money, even in uncertain times.